Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. We cover a lot of key topics in today's interview, from the S&P 500's all-time high earlier this week to supply chain dynamics, the success of Nvidia and Microsoft, through to luxury goods and the Asian consumer.
I'm James Yardley, and today I'm joined by Dave Dudding, the Elite Rating Manager of the CT Global Focus Fund. Dave, thank you very much for joining us today.
Thank you, James.
Now, Dave, it's been a very interesting start to the year. We've just had the S&P 500 going through 5,000 for the first time. I know your fund is a global fund, but it does have a substantial weighting in the US. So where are we for our listeners now? Obviously, we've had a very strong run for the S&P the last few months. I think we're up about 20% or so. How are you thinking about the market from here? Is it looking good value? And is there further to go, or is it time to be being a bit more defensive, perhaps?
Well, to be honest, James, we're not very good at market timing. So a year ago, I think we all felt that 2023 was probably going to be a bad year for the stock market, and that the US economy was going to flirt with recession. And actually, GDP growth was tremendously strong, and stock markets did incredibly well. So our track record at sort of macro forecasting isn't great. And I always think it's best just to try and focus on the things that we as investors know about, or at least think we know about, which is the sort of the prospects for individual companies. I really think it's very, very difficult to try and market timing is very, very difficult. And, it can be very expensive for investors as well. If they think that markets are expensive and then they miss out on significant rallies, then time out of the market is very expensive. So irrespective of the market moves at the moment, we still think that there are some great opportunities in the medium to long term. And as to what the stock market does this year, I'm afraid I couldn't really tell you.
No, fair enough. Of course, I think your strategy is known for being more of a bottom-up style. I think you're more focused on finding the highest quality, best companies from the bottom up, and then owning them for a good amount of time and letting them compound. What are you hearing from your companies on the ground at the moment? Are they in pretty good shape? And what are they saying in terms of supply chains, the inflation outlook, and some of the things which have been sort of dominating the headlines recently?
It's sort of pretty mixed, to be honest, and I think it very much depends on what you do. So in terms of supply chains, I think those have definitely normalized. There's obviously been a few scares in the past month or so about sort of traffic in the Red Sea because of the situation in the Yemen and obviously in Gaza. But they seem to be pretty mild. So from a supply chain situation, things have sort of more or less normalized. But now you do have this period where basically I think companies are prioritizing security of supply over and above efficiency. And that does mean you're seeing a move away from China, for example, which was happening anyway, partly because China's become fairly expensive for many things. And obviously, I think the world has woken up to the fact that the vast majority of the world's semiconductors are manufactured in Taiwan and South Korea, and sort of strategically, that's obviously fairly that's not ideal. So there is this sort of broader moves, I think, towards nearshoring and possibly reshoring, but also in terms of things like semiconductors, there's obviously a lot of stimulus on the parts of European, US, and even the Japanese government to try and encourage localization of semiconductor supply chains to an extent. So supply chains sort of normalizing in the short term, but some changing patterns in the medium term. And some companies that we invest in, I think, can very much benefit from those changing supply dynamics. In terms of inflation coming down, partly because those supply chain bottlenecks have sort of almost entirely disappeared. But I think what has maybe been a bit more persistent than people were thinking was wage inflation. So labor is in pretty short supply in many parts of the world. Obviously, pressures against immigration as well. And so wage increases have been quite high. And I think that will take sort of longer to quieten down. So we're still pretty much proponents of the higher rates for longer. And inflation, may prove slightly sticky or stubborn at sort of at around about these levels. So I think some of the sort of great optimism there was a month or two ago about interest rates coming down very quickly in the States. I think in the last few days that's been dampened somewhat. But that said, the US consumer is in reasonable shape. I think you've got pretty much full employment. And you've had some quite nice wage increases. So the US consumer's in a fairly healthy position. The US economy, if anything, has been too strong. So net, I think things are not too bad. But it can be quite patchy. So. There are pluses and minuses everywhere. I think one of the other big drivers, obviously, of markets in the last sort of year or so, and again in the early part of this year, has been the development of AI as a theme, and really there have been some great numbers coming out of the tech sector, some of which is largely driven by AI. And again, a sort of normalization after a period where spending on the cloud, for example, was slightly depressed, and that now seems to be coming back. So those sort of drivers are almost happening irrespective of actually the macro outlook. Meanwhile, you've got sort of areas where the US housing market is still fairly subdued. I mean, we think it's sort of bottoming, and there are some signs of life in residential construction, for example. But life's still sort of fairly tough there. So the picture's a bit mixed, and it sort of depends on where you are geographically. But on the whole, we do see inflation coming down, and at some point we think that we will start to see some interest rate cuts, certainly in the US. Possibly in Europe, but at the same time, Japan, actually, you're more likely to see rates going up. So the story's a bit different depending on which part of the world you're looking at.
So let's maybe dig into some of those things a little bit more. So, I mean, you mentioned AI, which is obviously very topical at the moment. How are you thinking about this? I mean, has it caused you to change the portfolio at all? Are there any ideas you're particularly excited about, or is it all getting a bit frothy at the moment? I mean, what are your thoughts?
We're quite lucky in that I think we were sort of believers in AI as a theme relatively early. So we've had a position in Nvidia, which is obviously the biggest beneficiary for quite some time. We've been, had big positions in Microsoft and Alphabet as well. I think so. So we are believers in AI. Although in some ways we see it really as a continuation of an existing sort of trend. But much now depends on the success of ChatGPT amongst other products. So we're really sort of, we've had a lot of initial enthusiasm, and I guess now we're in a phase where we really need to start to see that coming through in company numbers.
It's certainly coming through for Nvidia, isn't it? I mean, although the share price has up so much. I think the multiple, if anything, is pretty much stayed the same or maybe even come down slightly. So it's of course we get to see it, I think, as you'll say, to the wider product and universe.
Well, that's why the easiest way to invest at the moment in AI has been the semiconductor supply chain. So Nvidia is by far and away the biggest beneficiary, but you've also seen sort of some other companies like AMD, Marvell, and then the semiconductor sort of capital equipment manufacturers, ASML, Lam, Applied Materials, all these, Tokyo Electron the other day, all these companies are certainly, the big cloud companies and Nvidia are certainly ordering large amounts of chips. So that has been the easiest way to play the theme. And one of the reasons we were so bullish on Nvidia was last year, as you said, the stock went up 250%, but the earnings forecast went up by more than that. So actually, the stock derated, which is fairly hard to fathom when of a company that size. But forecasts at around about this time last year, they massively beat, and then they had a succession of earnings forecasts where they kept beating very, very significantly. And again, the stock was up, well over 200% last year. It's now up another 50% in the early days of this year. So these are fairly extraordinary moves. We haven't seen the numbers from Nvidia yet for Q4. They're going to be pretty good, but as ever, we're in a position of traveling and arriving, I guess, and some of this move has probably been priced in. So for the last few quarters, Nvidia has had great results, and the stock has actually probably gone down or drifted sideways for a while as people take profits. So it'll be interesting to see what the reaction is. I think people are not worried, but it's more, we know that 2024 is going to be a great year for Nvidia. So I think the debate is more about 2025 and also about increasing, or the potential for increasing competition as well from other companies. So, we're big believers in the story, but we have to temper that with a degree of realism, I think it's fair to say.
Yes, I mean, I think what's just scary is just the numbers are getting so big now. I think you've got to question how sustainable it is. But it sounds like you still think there's further to run with it, even though I think I don't know what the market cap for Nvidia is now. It's changing by the minute. It's probably getting towards 2 trillion or something now.
It's bigger than Amazon now.
Yes,
fairly incredible.
It does feel as if surely those numbers are unsustainable, or maybe the opportunity just is that big. I don't know.
Well, there's always a difference between the short term and the long term, and over the next 5 or 6 years, we do believe that this will be a powerful theme.
And what else are you really excited about in the portfolio away from AI?
I'm excited about everything in the portfolio. Otherwise, it wouldn't be in there. So,
some of the best ideas then.
well, we do have. Well, I mean, I think Microsoft, which is our biggest holding, I think is on a more palatable valuation than Nvidia, for example, and yet it's obviously it's very well positioned, I think. For the rest of the decade. So
is that on the cloud?
It's largely because of the cloud, yeah. So it's one of the big 3 sort of cloud providers, and basically it's gaining market share, and because of its relationships with corporates, it's in a very, very strong position. To benefit from that continued move to the cloud, as well as spending on AI. We do think it's well positioned. even within things like security, for example, there'll be more, there'll be beneficiaries of increased spending on that as well. So, and this is an industry with relatively high barriers to entry as well. So, that Microsoft is doing very, very well, and continues to be in a net cash position. So the balance sheet is very strong, and it has a lot of recurring demand. A lot of its sales and profitability are recurring in nature. So it's a great business, and we still think it's very attractively priced. I guess, some of the other things that people are interested in are always GLP-1s, so the sort of the weight loss drugs developed by Novo Nordisk and Lilly. We're holders of Lilly. Simply, we were holders of Novo as well, but we decided just to have one name in the space. But we are, quite big believers there as well, and it's important to highlight, these stocks have done incredibly well as well. I mean, they are the sort of Nvidia equivalent of the pharma industry. So again, there's quite a lot priced in, but we do think that these drugs are going to take off. The barriers to entry are fairly significant in terms of the manufacturing. She's very, very difficult. And sort of capital intensive, so there is set to be good growth in this field for a number of years to come. We're still longer term big believers in the rise of Asian consumers. Half of the world's population lives in Asia. People are getting richer, so we're still looking for ways to sort of invest there, and hopefully. The sort of energy transition. We're also sort of big believers in stocks that can help with that, and in particular with electrification. So companies like Schneider Electric, which is a French multinational, with sort of big positions in the US and also China. We see that as being a big beneficiary of those sorts of themes. Again, they're supplying data centers, for example. So a lot of that comes back to Microsoft, Alphabet, Amazon, and spending patterns there. But it is a bit broader as well, because Schneider are also benefiting from investment in the grid, in particular around the world. Really, as you need to spend more money on the grid to store and distribute electricity, particularly as more and more is derived from renewable sources. So there's still quite a lot of sort of exciting places to be, I think.
Yeah, it sounds like there are lots of exciting ideas in the portfolio. So how are you playing the Asian consumer? Are you looking to play the rise of India? And do you worry at all about the geopolitical risk there? I guess obviously some investors are quite nervous about China now. You still think there's opportunities there?
Well, we're quite underweight China, and conversely, we probably prefer India. But you can get a lot of exposure to the Chinese economy and the Indian economy through luxury goods companies, for example, or even consumer staples. A lot of businesses have exposure there. So, we own names like L'Oreal, for example, which is doing very, very well, but China has been a bit of a disappointment to them, certainly in the last quarter of the year. Conversely, luxury goods companies actually did much better than expected in the last quarter of the year. So, we own LVMH, but Hermes, Ferrari, these sorts of businesses continue to do very well in areas like the Middle East and the Far East, where basically there's a lot of wealth creation going on, and these names are big beneficiaries of those trends.
Brilliant. Well, thank you very much for joining us today, Dave.
CT Global Focus is a concentrated, high-conviction portfolio of best ideas. This is a genuine global fund which will venture into emerging markets, but only when it can find businesses which meet its strict quality criteria. For more information on the CT Global Focus Fund, visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.